Hello everyone, and welcome to our weekly call. I'm Rupert Watson, Head of Asset Allocation in our wealth business. Now that the emphasis for many is changing to the return phase of following COVID-19, it's time to change the frequency and emphasis of our webinars. Therefore, from June, this webinar series will be run once every 2 weeks, be theme-based and 45 minutes long. Our next webinar is therefore on the 11th of June, when I'll be joined by Teresa Beach, Mercer's UK Head of HR, who will chair a panel session around financial, mental, physical and social well-being. And please, as always, feedback any comments or suggestions you might have and reach out to us if you'd like anything from us. I'm going to start by giving a brief update on the restart, and for the first time in quite a while, talk about Brexit, for good or ill. Charles is then going to discuss why now might be a good time to invest in private markets. Hemel will discuss managing cash flow and scheme liquidity through the crisis. Jack will discuss how to start planning to make sure benefits and approaches address the needs of the workforce in the future. And Davide will talk about what COVID-19 means for transformation and change projects now and in the future. So if we turn to the first slide, we can see that there has been a substantial rally in financial markets over the last little while. In fact, one could argue a fairly remarkable one. So over the last month or so, as we can see, and this chart is for the S&P 500, so U.S. equities. U.S. equities are up 30%, give or take, over the last few months, which is an extraordinary performance. And making back well over half of their losses from the financial crisis. Indeed, equities, if you look on the right-hand side, the current level is higher than we were this time last year. And not many of us, I think, if we were to go back to this time last year and say my economic forecast is that the world is about to go into the deepest recession since the Great Depression, that we would have said that equities will go up over the next 12 months. And I think that some of the move is difficult to explain, but I think the main reason for it is that governments and central banks are committed to do whatever it takes to keep economic recovery, to ensure that economic recovery takes place and support companies, support consumers. And that provides a fairly strong tailwind to financial markets, particularly when and if we start to fear COVID somewhat less. If we turn to the next page, as you'll be aware, the startup has begun, so here's just a few interesting charts on that. Top left is number of trips on the road, rail buses, going back relative to the first week of February. And so you can see that rail and various other things collapsed and have stayed at somewhere near 10% of normal levels, while car trips, which is the blue line, fell to about 30% of normal and has now started to tick higher. And many of you who have been will have perhaps been out a little bit more than you had previously, and I've certainly noticed a few more people on the road near where I live. On the top right is for the Eurozone, and it's the Apple Mobility Index. The blue line is Germany, where there's been a pretty significant uptick in movement across Germany, and more recently we've seen a decent uptick in France as well. Bottom left is in the US, occupancy rates in US hotels. Now, of course, US hotels, or hotels generally, are rarely at 100%, well, except if you want to actually stay somewhere, but are normally not at full occupancy. And that occupancy fell to 20% 6 weeks ago, is now back up at 30%. And the number of people passing through US airports has started to go up. It had fallen to about 5% of normal in the middle of April, now back up at 10 and just over. So that's obviously still a long way below normal, but it's beginning to show some kind of recovery. And I think that more generally, the opening up will continue, although it will remain fairly unclear for quite a long time what normal looks like and when we will start to be able to do everything we want to do. If we turn to the next page, the next thing that we haven't really thought about a huge amount over the last few months is Brexit. But we're approaching a very important date, which is the 30th of June, whereby the UK needs to ask for an extension, if it wishes to have an extension, to the transition period that ends at the end of this year. The reason why it is easier to ask for it before June as opposed to wait to October is that on the EU side, if they were to agree to it, they can agree to it just by word of mouth, by Zoom call, by telephone call. Whereas if there was an extension request made in October, that would require a whole new treaty, which is procedurally very difficult. Now, you can see here from a survey that people in the UK, naturally enough, are very focused on coronavirus and not really focused on anything else, which gives scope for Boris Johnson and his government to seek an extension without being seen to be letting the Brexit side down. Although Brexit and his team continue to say they won't seek an extension, despite the fact that there's a huge amount to be agreed and there isn't a timetable to do it. So we're approaching a crunch point on the Brexit situation, and as things stand, it's pretty unclear what will happen. And at that point, I will hand over. But thank you.
Thank you, Rupert. Charles Delazardia here from the investment side. As you mentioned, many investors today may be concerned about the market environment and how COVID will impact their investment portfolios. Our experience actually shows that it's precisely at times like these that some of the most attractive investment opportunities will present themselves. And this is specifically relevant when we look at private equity, which essentially is a long-term investment through equity in private companies. Private equity has been getting a lot of focus from investors, and there's really three main reasons which we've listed here. Looking through these specifically, the first one, and probably the most important, is the ability for private equity to generate what we call an illiquidity premium. Fundamentally, with private equity, you're essentially trusting a manager for a much longer period of time with your capital. You're expecting them to have a much more hands-on approach to investing, which will probably mean paying them higher fees. But in counterparty to that, you're expecting them to deliver significantly higher returns than you would through, let's say, traditional equities or bonds. And that is really the illiquidity premium. And managers have really delivered on that premium. So, if you look at the U.S. market where we have the longest data sets for private equity managers, comparing those returns to the Russell 3000, which essentially represents the U.S. stock market, that premium has been of the order of magnitude of 5 to 6% over a rolling 10-year period. So significant premium has been generated, and that's one of the fundamental reasons for the interest. Another one, and this is the middle point and maybe more specific to what we're experiencing now with COVID, is about how private equity has behaved in downturns. And what better example to look at than the global financial crisis. During the global financial crisis, private equity experienced a drop of around 26% compared to equities. If we look at the period of 2008 to 2009, that drop was the order of 40%, a significantly smaller drop. Also, from an investment perspective and opportunities, the funds that were deploying capital, or the private equity managers that were essentially investing starting in 2008, have generated significant returns. The median return for those managers has been 12.9%. So again, very strong performance. Both those reasons explain why currently, in looking back at previous downturns, private equity has had some interest from investors. The third reason, and maybe this is a bit more specific to the opportunities and companies you can access through private markets and private equity in particular, is just looking at the opportunity set in the equity space and the number of listed companies. It's interesting to note that actually that number of listed companies has peaked. If you look at the US, it's peaked somewhere around 1996. Currently, we are at a level where roughly half the amount of companies that were listed then are still on the listed market. So when we look at the equity market, a lot of the interesting opportunities might no longer be listed. Another interesting trend is that we're seeing that companies are staying private longer. One telling example for that is the increasing use of the term unicorn. So obviously referring to private companies that have valuations at or greater than 1 billion. In fact, some of the fastest growing companies are really only accessible through private equity. Everyone will be familiar with examples like Zoom or TransferWise, but even if you're looking at more day-to-day brands like Lululemon, Tommy Hilfiger, or Journey Juice, all of those up to recently were examples of companies that were owned by private equity managers. So hopefully that gives a bit of the backdrop in terms of the reasons for the interest in private equity. Already pre-COVID, we were seeing a lot of interest, mainly driven by the low interest rate environment. Now, in addition to that, given the resilience and the opportunities demonstrated during the global financial crisis, it's really been a regain of interest for private equity. So really from our side, within investments, we think private equity will be a very interesting area to watch over the next few years. And with that, I'll thank you for the time and maybe hand it over to Hemel.
Thanks, Charles. I'm Hemel Poppers. I'm a senior investment consultant at Mercer's London office, and I'm going to spend a few minutes talking about liquidity and collateral. And it's interesting because the COVID-19 crisis in March this year led to a realization that people probably knew about all along, that stress scenarios can lead to forced asset sales. And if asset prices are low at points, then that can lead to long-term losses or underperformance. So many pension funds and other institutions have got policies in place to minimize these risks, and typically they would look at a long-term cash flow projection as shown on the top right, where they would look at their income and their outgoes, and they would map them and they would say, oh, there's a mismatch, but if we distribute income, we can manage, and there should be relatively low risk of forced asset sales. You can repeat that analysis in stressed market conditions, assuming that there is some hit to income distributions. Perhaps equity investments will deliver less dividends due to dividend cuts, etc., or perhaps contributions might fall, and you get a similar picture which shows a bit more tension and a tighter balance. So that is definitely well worth doing, and that's what I would call the sort of slow approach to liquidity stress, where a scheme is cash flow negative and at some point it's forced to realize assets at low prices. But actually, what tends to happen at times of market stresses is something quite different. It's what I would call a fast stress, where due to hedges and the use of leverage in a portfolio, you can end up in a scenario where you actually need to sell assets or unwind your hedges. And in either cases, you'd be locking in a loss. To give you an example, around the 19th, 20th of March, we found that many of our clients had currency hedges and LDI hedges both working against them. Essentially, gilts and sterling both became risk assets relative to the US dollar. And what that meant was that clients were facing currency losses on their sterling dollar hedges, where sterling fell to below 115 on one day and got quite close to it a couple of days later. At the same time, 30-year gilt yields rose from 0.5% to over 1.25%, and inflation rates fell to just over 2.5%. So all three of those would have caused pain to your scenario. So I think the key message there is be prepared and do think about the uncertainties, which are really going to, in some ways, be more important than mapping out predictable cash flows over the future. What's going to cause forced asset sales is much more likely to be a combination of capital calls, contribution cuts or delays, and capital calls from your hedges and or liability surprises. So what are the main ways that schemes can create resilience? The first is very obvious, hold a bit more cash. There's a balance to be struck, but holding a bit more cash is going to be very helpful. The second thing is distribute income from your whatever mandates are generating income. Don't get it reinvested automatically. You can always reinvest at your own option. And the third is to look quite carefully at how efficient your portfolio management is. Synthetic equity is often a much more liquidity-light way of investing in passive equity. Obviously, you can't invest actively in synthetic equity, but it is one way that you can reduce or capital usage whilst targeting a pretty similar level of asset return. So that would be, those sorts of approaches are definitely going to be helpful, and we don't think clients are likely, well, we don't think clients should assume they're out of the woods yet. I'll now pass over to Jack.
Thanks very much. Hi everyone, I'm Jack Curzon. I'm the Consultant Director at Mercer Marsh Benefits in the mid-market. I'm here today to talk a little bit about Generation Alpha and how the workforce of the future is actually inspiring the workforce of now to change the way we interact with people a bit better. So first of all, who are Generation Alpha? Here on the screen you can see a number of different of the generations that are often spoken about, but right at the bottom, this Generation Alpha, essentially the babies that are being born right now and will be born essentially in the next year or so. They could be post-COVID baby boomers themselves. So if you move on to the next slide, these Generation Alpha, what they essentially have are the simplest needs in the workplace. But in order to fulfill those needs, we'll have to put in place the most complex solutions. And that will be because their needs will be so advanced for the current age that they will have no expectation of anything other than the best forms of delivery. And they'll have no previous history or experience of any other models. And I'll explain a little bit about that in a second. But if you convert it to the current day terms, people have vastly enhanced experiences in their personal shopping lives or in their internet lives about, buying items either through their smartphone or otherwise. They can get delivered instantly the same day, and they can even do returns on the same basis. Unfortunately, there are processes in the workplace which still involve paper, which still take days, if not weeks, to complete, and are run around payroll cycles that don't match up with the same needs in technology. And that's okay for the moment because we're still catching up. But this Generation Alpha that will be in the workplace in the next 10 or 15 years' time will have a completely different set of needs and expectations. Where that actually converts to the conversation today is that the COVID pandemic has forced us, whether we've liked it or not, to work differently and evolve a lot quicker in the way we're dealing with people in the workplace, the way we're communicating, etc. So now is no better opportunity to actually accelerate that evolution and deal with the workplace in a way we've never dealt with before, deal with employees and colleagues in a better way, so then in 10 to 15 years' time, we won't be potentially trying to bridge an even bigger gap as to how we deal with the next generation of the workforce. You can see in the blue boxes on the screen, these are the high-level topics that the Generation Alpha type people will be expecting. They want the best technology, slick communications, social interactions with people that is very, very simple, transparent communications, ethics, sustainability, and equality in the workforce that lots of companies are just starting the journey to kind of nail now, but we need to move forward a bit more. So a great example of that, if you go on to the next slide, is how a lot of people, I'm certainly of a generation where I didn't grow up with a mobile phone, and my parents, for instance, they were lucky enough to have mobile phones through work that were these kind of brick telephones with huge batteries on them. But we evolved very quickly into this world where phones were much more readily available, something like the Nokia 3310, which had, some of them had cameras on, they had games, you could text and call people, multifunction, and amazingly, you plugged it in once a week to charge it. That seems like such a novelty these days. The iPhone in 2007 revolutionized that approach, but not much has actually changed in the last 13 years there. People, yes, have adopted more devices, which is the 2 iPhones box. And personally, for instance, I have a work phone, personal iPhone, a couple of iPads for the children around the house, and maybe some old devices too. But the Generation Alpha of the future, we don't know what their devices will look like, but they will certainly be more advanced than they are right now. And I think they will also be a lot more advanced in the next 13 years than the previous. So the workplace has to catch up with that in order to facilitate the best processes for people and duplicate that retail consumer-based approach that they will get in their personal lives to the workplace as well. So if we just go on to the next slide as a quick placeholder, 2020 has not worked out the way anybody thought it would do, and we've heard from several colleagues about how that's hit the finance markets just now. Now, the way that this will accelerate the way we deal with the workforce now is really positive, though. So if we just move on to the final slide, I'm going to talk about how we actually deal with the impact of COVID for our people can be really positive. We can turn a negative into a really positive thing, utilize technology to connect people quicker. And there's some great examples out there of how people have had to work from home. They haven't had the devices that they needed to do that, but actually we've been able to accelerate that process and get laptops or computers to them within a day, rather than waiting weeks that organizations might have to have done in the past. But we've had to do that reactively. There's nothing wrong with that, but we need to continue that momentum to be able to work better and quicker together, certainly for groups of employees out there, so we continue the momentum to deliver that consumer-grade, future-based approach for people. Ultimately, I'm a huge passionate advocate of this as well, that benefits and anything that a business is doing for their employees in the workplace should impact their health, be it physical, financial, mental, etc. Because we want to make people healthier, happier, more motivated, and that would impact the businesses we work in to deliver better results. But we have a long way to go. I think the final thing I'll finish on is how, bizarrely, I found my personal experience in the COVID pandemic is I've gone from having multiple channels of communication methods to kind of 2 at the moment, and that is a video conference, webinar, Zoom type approach, or an email. I've lost my phone calls, I've lost my face-to-face interactions with people, those water cooler conversations. And that's something we need to adapt and change in the short term in order to get better outcomes for our people initially, but longer term, this isn't going to go away anytime soon. So we need to start to be more proactive to deliver better messages to people in different ways. So in the post-COVID world, we're starting to enhance the experience now for our people, let alone for this Generation Alpha, which is 10 to 15 years away, which is going to be a much bigger gap to fill. So I'll take a breath there. I'm going to pass over to Davide, who's going to talk about what COVID means for transformation and change projects now and also in the future. So thank you.
Great, thank you. Very interesting. Hi, everyone. This is Davide Pediglieri. I'm the HR transformation lead in the UK. And I'm going to talk about how COVID has affected HR and the transformation journey. As you can see, the slide is basically split into 2 halves. The one on the left-hand side is basically a very quick go through what are the main drivers that are pushing HR transformations and how they're changed because of COVID-19. And on the right-hand side, I just wanted to put a few thoughts around what we see in the market and what are the main topics that we've been discussing with our clients in these last couple of months. If we start with the HR transformation drivers, as you can see, the first point is around what is the role of HR in pushing forward with HR transformation. We do believe that HR stays catalyst of transformation, and obviously, considering the context that COVID-19 brought in, this is even more important and more needed. If you think the role of that HR plays in the organization, staying close to the employees, monitoring the whole life cycle, this is definitely a privileged role. Also, if you think the type of data that HR professionals have access to. HR plays an absolutely key role in making sure that the HR transformation is successful, but it's also very important for organizations that HR is structured in the right way and it's a strong function, with strong capabilities. And this is actually that news that takes us to point number 2, which is, even before COVID, talking to our clients and, running surveys, we do know that HR hasn't been in a great shape in the last years. And also, we are aware that the role that HR has been playing has been quite often behind the leading role. So HR is not stepped up, is not been leading on digital transformation, for example. And I'm sure that you've come across an internet meme where there was a question asking who led digital transformation of your company, and basically you had 3 options: the CEO, the CTO, or COVID-19, and the pick was of COVID-19. Well, our answer would be the CHRO. The third point is about, let's say, the emotional side of this big change that we're going through. So for us, HR is essential in reactivating and re-energizing the workforce, especially in the ramp-up. There's a big, big human and emotional side in this COVID outbreak, and we do believe that HR plays a key role. The second last is about the talent. We have seen lots of our clients obviously changing their agenda around talent management, talent acquisition. Now there's a much bigger need in retaining those capabilities and skill sets that have become key to make sure that the company can actually get through this outbreak. So we have seen a change between a strong push around talent acquisition, but a more, let's say, meaningful approach to retention of talent. And the last bit is around the crisis products that we are seeing around. There's so much right now. I'm sure that your LinkedIn feed is crowded with companies pushing content, POVs, new methodologies, new approaches. We do believe that we need to start from the human. We need to focus on people, because this is what HR needs to strive. If we now move to the right-hand side of the slide, I just wanted to put a few focuses on what are the contexts and what are the changes that we see in the market because of COVID-19. So obviously, COVID has been a huge accelerator, and the change is now way more complex. It involves culture, it involves operations, processes, roles. So let's say that the scenario is way more complex and it changes way more rapidly. Digital has always been a big focus, and we can see that the rush to digital has become even more important. More and more companies are asking support and help in identifying the right digital tools to adopt. Our comment on this is, before rushing into digital, what is really important is to make sure that we are capable of unlocking the value of digital and technology. How to adapt to the new? The main focus is still about skill sets and the learning, and this connects with the human-centric approach. The focus during this change should be on people, on their skill set, on their motivations, and on the plan to move forward. And the last bit is about the CHRO. As I touched on this briefly earlier, the CHRO needs to play a different role. It must be more connected with the business. It must have a much stronger leadership, and there's a very interesting quote by the CHRO from IBM, who is, during the crisis in 2008, there was a financial crisis. The CFO in the organizations played a huge role and basically had the companies to go through the crisis. Now in 2020, with the COVID-19 outbreak, the role that it has to play, that role is the CHRO. I'm now going to hand over to Rupert for the roundup of this session. Thank you very much. Rupert?
Yes, well, thank you very much for that, and I thank you very much, everyone, for tuning in. I hope you enjoyed that. And as I said, the next one of these events is in 2 weeks' time, but it's a slightly different format, and so I hope you will be able to join us for that. As I said, reach out to any of us if you have any questions, comments, or thoughts. But thank you very much once again. Bye.